Welcome, everybody, and delighted to have with us this evening Mason Doick, who's the head of corporate development for JP Jenkins Limited. They are a company that's all about liquidity in private markets, of which before first meeting Mason and his company, I knew very little about, but is a fascinating area. And we're very lucky to have JP Jenkins. They've actually sponsored one of our dinners, and actually it was during the dinner, it's one of those dinners where we had the most questions to our sponsors, so it begged the question, why don't we set up a seminar like this to go into a little bit more detail what they have to offer and learn a little bit about the market. So I am delighted to introduce Mason. Mason, we look forward to getting your comments. Also, as with myself, if I could ask everyone to mute themselves now. And as Charlotte suggested, feel free to unmute yourself to ask questions. We're a relatively small group, so we'll keep this as interactive as much as possible. Mason, over to you.
Thank you, Nick, and thank you, Charlotte and Nick, for running this, and thank you guys for attending today and giving up your valuable time. As Nick said, we were delighted to sponsor the FANG dinner a number of months back, and a number of questions came out of that, and we thought it would be very valid to at least put on a webinar or a seminar to discuss liquidity in private markets, more so in sort of further detail. As Nick said, so my name is Mason Doick, Head of Corporate Development. I previously have worked in capital markets and private markets. I did a number of years allocating to fund managers and hedge funds, and then actually did a number of years actually allocating tax efficient investments to private businesses as well, and raising capital for them via sort of EIS and SEIS tax schemes. So you may not be familiar with them in the US, but in the UK, obviously they are tax efficient investment schemes that we find in the UK. Our topic really today, as you may have all seen, is liquidity in private markets, and one that's close to our hearts. So we find that there's been significant amounts of capital, specifically if we look at EIS in the last 12 months or so. I think there was around 27 billion in 35,000 companies, and this is just in UK, domiciled companies. And the liquidity was very, very, very small. So we're thinking sort of single figure digits here, between sort of 4 to 6% rate of exit or liquidity for those investors and shareholders. And really in the US, the guys over there do it, or the women over there and guys do it incredibly well. Secondary markets in the US are booming. It's a multi-billion-dollar market. There's lots of different players. There's the likes of Forge, the likes of MVP, Manhattan Venture Partners, the likes of Equity Zen, and the list goes on and on and on. And in the UK, we seem to be sort of 10, 15 years behind the US with a lot of our sort of enhancements and developments and technology. And really our chairman, Malcolm Byrne, who's a City veteran, been around the world, done sort of lots of different things from SPACs to public market listings in Hong Kong, New York, London, and really saw the benefits of the US secondary market, and was involved in the likes of Palantir and Airbnb and many others, and said, actually, well, why have we not got this market and an opportunity in the UK? So JP Jenkins had been around since the 90s. Our founders can trace their roots back to the unlisted securities market, all the way back to the sort of 60s, 70s, 80s and 90s. And JP Jenkins worked alongside at that time with OFX. OFX was essentially the unlisted or off exchange market, and JP Jenkins was the dealers behind that. And it was really about providing liquidity for unquoted companies, or potentially companies that were looking to go onto a recognized exchange in 12, 24 months or so. So what we had is, over the years, we had a lot of companies come to us. And in the sort of 2-3 decades ago, we worked with a lot of the football clubs in the UK. So we had the likes of Liverpool, Man City, Chelsea, to name a few. And a lot of their fans wanted to buy and sell their shares. We then had the likes of Weetabix, National Car Parks, Adnams Brewery, some British brands that are well known over here that are now listed on public exchanges that utilised our platform. And now our real focus coming into this century is looking at SMEs on that growth stage. So whether they look to remain private but want liquidity in their shares and trading in their shares, or of course, if they're on that IPO route and they're looking towards a potential listing in 12, 24 months or 2, 3, 4, 5 years, and really getting that company ready and providing a facility for them to do so. And I think most of you that maybe here have invested in probably in some way or another, whether it be in public markets, private markets. You find in the UK that typically public markets can be difficult sometimes to get liquidity on the bottom of the junior markets. Also, of course, if you're investing in private companies, then liquidity is very difficult to come by unless there's some sort of corporate action or IPO or MBO or trade sale. And JP Jenkins really has been on a mission to change that for about 33 years. So we work quite closely with the UK recognised exchanges, so the likes of the London Stock Exchange and the AIM market, the junior markets, but also Aquis, which is also another junior market, which was formed from our old counterparty OFEX, and really working with these exchanges to be a sort of incubator for these companies if they do so wish to list in the future. For a lot of companies, we find that private businesses don't always let their shareholders know what's happening day to day or month to month or quarter to quarter. And we find that through our platform, the real focus is increasing that investor relations, that corporate governance, and making sure that company, particularly the private companies, are keeping those shareholders and investors engaged with what that business is doing. So whether that be regular announcements, press releases, much like if they were listed on a public exchange, or putting out internal comms to those shareholders and investors to make sure that they know where they are. But to be completely, to make it as simple as possible to understand, JP Jenkins essentially is understood as essentially, in inverted commas, a private stock exchange. So companies are admitted to the platform. We trade on a matched bargain basis, which means there's no wide spreads. There's not the onerous reporting standards of being on a public market as such. And really those investors and shareholders can place their buy and sell orders exactly as they would on the London Stock Exchange via their brokers. And we have a dealing desk that manage those orders. So a very simple format and a very simple matching process for both those buyers and sellers. And we really try and take out any costs for those investors and shareholders to make sure that there's as much liquidity in the market as possible. So it gives an opportunity for shareholders to take profits. It gives them an opportunity to see their company or the companies they've invested in and manage their private portfolio more efficiently, but also have a bit of a trading history and a live indicative price and valuation on those companies. I hope that's given a bit of a background on JP Jenkins and what we do.
That's fascinating. Thanks, Mason. I guess just curious on my side. So how actually does that work? Let's say, take myself, I've gone through one of the, online platforms and made a small investment in a private company. How do I get through to JP Jenkins?
Sure. So the pain point for us really is we can't have single share issuance. So we have lots of investors, maybe like yourself, Nick, that have got lots of investments in different private portfolios, however small or large, and they say, actually, can we sell some of that position, or can we take profits, or can we sell down a piece of that? And we'd love to do that, but realistically, we have to have the company onboarded to the platform. So much like the stock exchanges, we would need the company and the board to first admit to the platform. It's a very simple process, so it's nothing like you'd find on a recognized exchange. As long as the company itself has been trading for at least a year to 3 years, has sort of revenue generating business that we can see as a proof of concept, and we do the usual DD and KYC AML documentation, so know your client and anti-money laundering for the board of directors and majority shareholders, it's a very simple admission process. And typically that can take between a week to 2 weeks. But for yourself, if you were a shareholder in a particular business and the company was trading on the platform, all you would need to do is, if you have a stockbroker yourself or an LSE registered broker, instruct them to contact us and place a buy or sell order. Or if you don't have a broker, we have a number of recommended brokers that we advise any shareholders, investors to use. And it's as simple as placing an execution only order through their broker.
Mason, would they have to change their articles and their shareholder agreement to
So
those few weeks?
So in regards to the actual listing itself, because we mirror the same infrastructure as the LSE, it settles through Crest, so the shares are dematerialized. So that's a very good point, is the fact that in most cases of certain private companies, you have preemption rights in place, and those typically are disapplied to make the shares freely transferable so that they can settle through Crest. So typically companies that are coming to us already have that in mind, that they're going to disapply those because they know that they're either looking to IPO, which you have, of course, disapply them anyway, and of course coming to us would be much the same.
I can see the advantages to the sort of private investor. How about for the listing company? What are the advantages there?
Sure. Well, there's a number, really, Nick. It's a multifaceted platform, and I was actually speaking to a corporate finance house today, and a number of the investment banks, and really for companies it's a multitude of opportunities. So they've got companies that come to us and look at us as an M&A or a way to leverage M&A activity. So they'll have clear visibility on price and valuation, use part paper, part cash for acquisitions, but actually not look to do too much trading because their free float is not available as such. There could be other companies that come to us to improve their investor relations and corporate governance, and keep those shareholders engaged with what that business is doing month to month if they don't have an investor relations portal page themselves. We then have other companies that will actually utilize the platform when they're raising capital to leverage a higher capital raise, because those same investors and shareholders have peace of mind that they're investing in a business and they can ride out a bigger ticket size. But if anything was to change in their lifestyle and they needed liquidity, they could actually sell through the platform. And then, of course, the main optionality is having trading history in the shares. So companies that are looking to potentially list as well in the UK can actually have trading history through our platform, bolster their share price and valuation through the proven metrics of the trading, and really give sort of wider visibility to a wider investor audience. We know that the IPO route is quite a difficult one for companies or individuals that don't understand the capital markets as such. And there was actually some interesting articles and sort of write-ups that I covered recently that we were reading about, that companies statistically that had an IPO readiness in place had a more successful 12 months following an IPO. And that really is down to visibility, price, understanding of the market and how that will affect your share price and company moving forward.
Can you give us an indication as to the sort of costs of a company to join your platform, and also the level of disclosure and information that would be available to investors through your platform? Sure,
yeah. So very nominal fee. So we, when you probably look at the likes of Aquis or AIM, I think taking into account all of the costs and fees involved, I think Aquis, we're speaking to the registrars this afternoon, is around sort of 250,000, £250,000. AIM, we're looking towards £500,000 for a listing, and we're sort of the sort of middle ground or the incubator towards those listings. Or some companies, if ever, never want to list, but they have a trading mechanism via us, then they don't require that. So our cost is typically around £10,000 for a company to be admitted to the platform, and that includes it's essentially an annual cost, which includes regular and quarterly press releases for each company that is onboarded. It also includes our comms to our internal investor community of around 12,000, but also each company has their own corporate profile on the platform. So through our website, you can see the companies listed on the platform or the market, so to speak. And really all of those companies will showcase as much information as we can garner from them. So for the second question, to answer that for you, each investor or shareholder that's looking at those companies in particular will be able to see the board of directors, will be able to see the management and their bios, will be able to see their accounts and reports for the last year, 2 years, 3 years. They will also be able to see on particular companies investment memorandums or pitch decks or investment information on the company and their future prospects moving forward. And then also we have sections on there that have their trading history, so number of volumes of trades and price over the last 12 to 24 months. And then we also have updates as well. So any news reports, updates, press releases, we will have showcased on each corporate page as well. But we do say that, of course, it's down to the investor to make their discretion on or informed decision on the investment. We purely act as the sort of incubator, the facility to match those expressions of interest to buy and sell, much like a bulletin board or a match bargain trading facility or secondary market, however you describe it.
Okay, so the investment memorandums, etc., it's just whatever the company wants to put out, presumably. It's
so
not specific to your platform.
No, so yes, so we will obviously, of course, do the level of DD with the company. They will also go through a due diligence process with the registrars to have their shares put through Crest and the LSE. But in terms of the actual information they provide us, that's provided by the company. So we do verify as much as possible, but of course, in private markets, it's what the company provides us with is typically what we will showcase. But most of that is public knowledge, or pretty much all of it is public knowledge.
Okay, thank you.
Just a question: who are typically buyers and who are typically sellers?
Yeah, so that's the main question that everyone always asks about liquidity: who the buy side are. That's what the companies typically ask. So we have a big list of contacts that we have spoken to, investors over the years. We've got about 85% are high net worth, sophisticated investors. Usually, domiciled in the UK. We do have international investors as well. But typically, because you have to trade through a broker or an LSE registered broker, there are more UK domiciled investors. If there are international investors, they usually use a brokerage which has a UK arm or division, or a bank that has a UK arm or division. We do have a small percentage of corporate investors that will do anything from sort of 1 million to 10 million, or even upwards to 50 million, depending on the equity and obviously lots of different variables. And also a number of family offices that will invest anywhere from 1 to 5 typically on those secondary transactions as well. Most of those investors are going through their brokers, so we don't know all of the underlying shareholders as such, because it's going through that registrar sort of system in Crest. But the sellers and the buyers are typically sophisticated investors. We wouldn't want to sort of position ourselves in, much like if you see in the UK, the sort of crowdfunding sort of side, where there's a sort of an individual buying one share and selling one share here and there. We'd hope to be a bit more sophisticated in the sense that we have bigger buyers buying bigger blocks and bigger sellers selling bigger blocks, because it makes it a lot more easy for administrational purposes for both the company, ourselves, the registrars, and trading.
And again, maybe a follow-up question just on the nature of things. Is it just UK listed companies, or do you do other locations as well?
So that's no, very good question, Nick. We built last year a beta platform for all international domiciled companies, all international domiciled investors, without the need to use brokers. Using the technology that we have at our fingertips today, it should be that way. And we built a very intuitive platform called Direct, where shareholders and investors can actually log on, have their own account, much like you'd have with a Hargreaves Lansdown or an Interactive Investor or any bank or broker you use to trade over in the UK or the US or wherever you're based. And very, very, as I said, intuitive platform. We had a couple of testers which worked incredibly well. We actually had a company that sold 300 shareholders sold at 3 times 2 multiple on an investment after their tax release were received in the UK, and we had 4 large investors take them out and replace them. So it was a very good sort of tester model that we used. The unfortunate situation at the moment is that we actually had new rules come through from ESMA and the EU and UK directive, which is reviewing online marketplaces and trading, that came through in April. And we're just finalising the last bits and pieces with the FCA, the regulators in the UK, and the last sort of compliance pieces with our team before we can launch that. So that will be coming soon, and hopefully we can launch that, and that will be all encompassing for all international companies. But at the moment, we're pretty much solely focused, I'd say about 90% UK domiciled companies. We do have a couple of Canadian companies because they have a similar settlement system via Crest. So as long as we can have settlement going through a sort of similar Crest enabled process, then we can onboard them onto our so-called traditional platform at the moment.
Thank you. Do we have any other questions from the participants?
So Mason, I just want, yeah, I wouldn't mind asking about the primary market, because you mentioned primary market as well as a secondary. So if they're doing a capital raise, how does that work? Is it, if they want to have new shares as well as buy secondary, how does that work in practice?
Yeah, of course. It's a question we always get asked because typically every company is only 12 months away from another funding round, we always find. And given my background with capital raises, that usually is the case. When I say primary, so our primary focus is secondaries, and we predominantly only deal with pre-existing shareholders selling to new investors and new buyers. And that's all our main sort of premise. We are looking at the opportunity of actually doing primary new capital raise, new issuance of shares facility through the platform directly. But at present, if companies want to raise funds, we have a number of partners that we will introduce them to. We've actually got a company at the moment that's micro cap in the scheme of looking at it from a US model, about sort of 16 to 20 million market cap, million pounds. They're actually looking to raise 2 million. And what we're doing is going through our partners at the moment. We've got about 124 different entities. So that could be sort of EIS, SEIS funds, corporate finance houses, small cap brokers, unquoted divisions, who will raise money for these businesses. And depending on the sector of the business, the size of the investment and what they're looking for, we will then make introductions and do sort of more of an offline book build for them. But the actual capital raise itself and issuance of shares doesn't go directly through JP Jenkins, just due to the fact that we don't, sort of that's not our key focus, and we haven't got the mandate to capital raise as of such.
Just another, probably a final question from me. What kind of companies benefit most from listing through yourselves? What, what works best? Because I assume some are better than others in terms of benefiting from this.
No, exactly. We have a very wide range of companies that list on the platform. So typically, to give you a bit more of a bit of history, given sort of 2005 to 2008, following on from that and the crash, a lot of companies prior to this were really focused on IPO, and that was always the exit route, and everyone was sort of besotted by an IPO, and that was sort of the position to have, and your company sort of made it if you did IPO. We found following 2008, IPOs dropped off quite significantly, and companies that were listed on AIM or Aquis or even US markets started to delist and come off the platform for a number of reasons, whether it be onerous reporting standards, lack of liquidity, costs to listing, and the list go on. And typically JP Jenkins was being used for those companies. So a lot of companies that came off the UK market still required an afterlife for their shareholders. And naturally, of course, a lot of delistings did come to the UK and did come to our platform. And that's a very, very simple process for us, because naturally they already have an ISIN, they're already settling through Crest, and they can just fit in perfectly with us, and we can manage the trading for them. So to answer your question, a lot of companies used to come off market to us, but now we're really focusing on companies that are looking to go on market, so in terms of IPOing, or companies that are not looking to IPO if ever, but actually looking for trading in their shares and liquidity in their shares. Maybe it be to retain talent and staff. It may be to provide liquidity to stakeholders, non-exec directors, early family and friends that have invested, and the business is worth a significant figure, but they're still eating rice and beans and haven't taken any money out of the business. So it caters for a lot of companies. We specifically say that, of course, if there's a business that's wholly founder owned, or there's only 1, 2, 3 shareholders, then it doesn't really make sense to have a market as such, or a secondary market or trading facility for your shares. But if a company is sort of post Series A or has over sort of 50, 100 plus shareholders on the cap table, then it can start to be beneficial. We know a lot of companies will internally broker between, if an investor like yourself, Nick, says that I want to sell some shares, and another shareholder says, actually, I'll take those shares off you. We know a lot of companies have done that in the past. But as that shareholder base grows and it becomes more complicated and the company goes through further funding rounds, with different asset classes or share classes, then it does become a bit of an administrational burden to the company. And that's where we come in to provide a more professional service for both managing that sort of cap table and trading for that company in particular. The companies actually listed on the platform are anywhere between 1 million market cap all the way through to 200 million market cap. We've got a number at the moment that are delaying their listings in the UK just due to, unfortunately, the market conditions currently and the uncertainty we find ourselves in. And they're in the remit of 300 to 400 million plus. So, you know, it can be a lot larger, it can be a lot smaller. The best businesses that we see benefit from the platform are in the space of sort of 15, 20, 30 to 50 million market cap, because that's when there's that sort of real growth stage and a lot of interest from investors, potentially pre-IPO as well. So I would say it's a very difficult one to answer the question specifically, but companies should always bear in mind a liquidity option for their shareholders. I think that's key. Naturally, of course, if a company is looking at an IPO, then it's really a no-brainer to utilize a trading facility prior to a listing and build out that price discovery. And of course, if companies are of a size where it makes sense and they've got significant investors and they're going through a number of funding rounds, that's when we would typically see them get in touch with us or put in touch via their accountants or their lawyers. And it used to be the case that you'd always have shareholders knocking at those companies' doors asking for some liquidity for whatever reason. Maybe the daughter of the investor needed to, but these are certain circumstances I've come across, to fund a wedding or buy a house or help their kids with a purchase of something or whatever it may be. And that's where we sort of step in and we can help those shareholders exit, and the companies are then introduced or sort of slightly nudged to utilize the platform for those shareholders. And the main thing for us is really putting those shareholders first, being proactive instead of reactive when the issues arise. So very broad ranging. We're sector agnostic, as any marketplace should be, and of course the size is quite wide ranging as well.
I said that was my last question, but I have one more, actually two things. First of all, you know, with the democratization of private investing and online platforms like Crowdcube, as an example, in the UK, how has that changed your business model, if at all, you know, since the 90s when you started?
Well, it's funny. So when we started, we didn't have all of the VC houses and private equity houses and crowdfunding sites on all the popping up around London. And, you know, we really were the hub for secondary market trading, or at least unlisted securities trading. And at that time, we were doing around £1 billion in transactions. Nowadays, we see it that it's actually bringing a positive light to secondary markets. And as I said, following on from the US model, personally, our team and board think that actually the more individuals within this space, actually the more noise that will be made around secondary markets, and that will help increase the educational side. You know, in this instance, obviously doing this seminar is perfect because a lot of individuals, as you said, Nick, aren't aware that there's an exit opportunity or a liquidity opportunity for shareholders or investors, or even company founders, directors, board members. So crowdfunding coming into this is actually quite beneficial for us. And their model is very different. They've got their own sort of secondary market set up, but it's very much within that nominee structure. So if you buy shares within Seedrs or Crowdcube, you can then sell shares within Seedrs and Crowdcube. And we work very differently. We're more of a inverted commas again, but we're not classified as an exchange, but I will say we're similar to an exchange in the sense that we can provide a trading facility as and when the investors and shareholders need it, and you don't have to be within that nominee structure. And of course, it comes with less costs of trading as well, which is sometimes levied on the crowdfunding sites. So we see ourselves as sort of the next step up, but before any sort of public listing. And really, I think democratization of wealth is massive. I know that our chairman's a very big advocate of discussing this. There's going to be the biggest wealth transfer in the world in the next decade. Specifically, even when we've done research in the UK, there's significant amounts of wealth and companies being transferred over to younger generations. Unfortunately, some of these younger generations are not focused on the old economy businesses, and they want to make some new tech product or SaaS product or some sort of altcoin, which we'll see how that develops. But I think that moving forward, it's going to be an important step to have some sort of liquidity mechanism in place as these companies grow. And funnily enough, a lot of these crowdfunding companies actually do come to us now, because they say, we've gone through the crowdfunding, we've done incredibly well, we've raised the money we've needed, but we've now got 3,000 shareholders on our platform or on our cap table, and we really need some help with restructuring that or refreshing the cap table, helping some of them access liquidity before we look at listing.
Brilliant, thank you. I'm done with questions. Any other questions from the audience, please?
So I'm just curious about if you're doing a raise though, because normally when you're doing a raise, the secondary market would be a different price potentially to the share price, right? So there'd be a discount.
So exactly. So we will, to answer your question, Rob, so every company that raises through our platform, we will typically put on hold, so they cannot transact through the secondary market when they're issuing and raising new capital until that fundraise is complete. So there is no arbitrage trading going on. And when any company is admitted to the platform, we usually start it from their last funding round or third-party valuation. So typically it's in and around that price that they've either recently fundraised for, or in sort of 6-12 months time, if they're doing another funding round, then we will put that on hold. And then if there's a significant change within the business or whatever that may be, then we can reevaluate the valuation of share price. And typically with the trading on the secondary market, the share prices will move with the fundraiser, with the share, with the trading and the demand as well.